Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries that shape our world. And today we're diving into a report that might just make you say, hold my Bitcoin, because it involves a lot of it. Strive Inc. has just dropped a report that tells us a few interesting things about their cash, their stock, and a rather significant change to how they're paying out dividends on a special kind of stock. Stick around because this one has some juicy tidbits about how they're managing their assets and rewarding shareholders. Before we dive in, if you like getting clear, no-nonsense breakdowns of company filings, make sure you are subscribed. And if you want to chat more about these reports and connect with other savvy investors, join our Discord community linked in the description below. So Strive Incorporated, or Strive as they call themselves, is based in Dallas, Texas. They're a company that has got a bit of a unique approach to its assets, as we'll see. Let's get straight to the point, which is what happened on the 11th of February 2026 and a few days later. As of the 11th of February, Strive was holding a substantial amount of cash and cash equivalents, around $127.2 million. But that is not the headline grabber. They also held over 13,000 Bitcoins. Yes, you heard that right, 13,130. On 9.8 Bitcoins. That is a significant bet on digital currency. Now let's look at who owns a piece of Strive. They've got a large number of Class A common shares out there, over 53 million. Then there are Class B shares, nearly 10 million. And importantly for what is coming next, they have over 4.2 million shares of what they call variable rate series of perpetual preferred stock, which they've cleverly abbreviated as SATA stock. This is the stock that is going to be at the center of our dividend discussion. Here is where things get interesting for the holders of that SATA stock. On the 13th of February 2026, Strive's board of directors decided to boost the dividend rate. They took the annual dividend rate on this preferred stock from 12.25% all the way up to 12.50%. This change was set to take effect for all the monthly periods starting on or after the 16th of February 2026. Now, 0.25% might not sound like a lot, but when you are talking about preferred stock that is meant to provide a steady income, any increase is a welcome one for investors. To put that increased rate into concrete terms, on that same day, the 13th of February, the board declared an actual cash dividend. Each share of SATA stock will receive a cash dividend of $1.0417. This payment works out to be that new annual rate of 12.50% on the SATA stock. For those holding this stock, this means a nice little bump in their income. The payment is scheduled for the 15th of March 2026 to all shareholders who own the stock by the end of the day on the 1st of March 2026. Now, let's touch on how this dividend is treated for tax purposes, because this is pretty significant for us federal income tax if these dividend payments aren't considered to be coming from Strive's past or current profits. They're basically treated as a tax-deferred recovery of your initial investment. That means you don't pay taxes on it right away, and for investors who are not from the US, this payout is actually exempt from US dividend tax withholding. This makes it a very attractive proposition for both US and international investors in this particular stock. And the reason for this tax treatment is pretty straightforward. Strive states they have no accumulated earnings and profits from the past, and they do not expect to make any profits anytime soon, even in the current year or the near future. This strongly suggests that these dividend payouts will continue to be treated as tax deferred or tax exempt for investors, which is a huge advantage. Now, like most public companies, Strive includes a standard cautionary statement about forward-looking information. This is essentially them saying that some of the things they talk about involve predictions about the future, and that the actual results might be different. They're upfront about the inherent risks and uncertainties involved in these predictions. They also highlight some specific risks. One major area of concern they mention is the possibility that the anticipated benefits of a merger transaction they're involved in might not happen as planned. This also includes potential problems with how they implement their strategies for holding Bitcoin and other digital assets, as well as the usual suspects like economic conditions, interest rates, and changes in laws and regulations. This is a clear nod to the volatile nature of their Bitcoin holdings and the broader market. They point to other filings for more detailed risk factors. This refers to their past annual reports, specific merger, related filings, and even reports from Semler Scientific, Inc., which implies a significant business relationship or upcoming merger. It's standard practice to cross-reference these. But it tells us there is a lot more going on behind the scenes that could impact Strive's future. And finally, the report is signed by Matthew Cole, who is the Chief Executive Officer of Strive, Inc., confirming the information presented. Alright, so what do we make of all this? Strive is making a bold move with their substantial Bitcoin holdings, which is a high-risk, potentially high-reward strategy. The increase in the SATA stock dividend rate is a positive for those specific shareholders, especially with the attractive tax treatment due to the company's lack of profits. This suggests Strive is prioritizing returning capital to these investors. The extensive risk disclosures, particularly around their digital asset strategies and potential merger implications, are important to note. They're signaling that while they're charting an aggressive course, they're also aware of the significant challenges. In my opinion, Strive is walking a tightrope. Their Bitcoin bet is a massive gamble that could pay off handsomely or lead to significant losses. The increased SATA dividend is a smart move to keep a key investor base happy, especially with the tax advantages. However, the fact that they have no earnings and don't expect any suggests they are not currently a profitable operating business in the traditional sense. Their strategy seems heavily reliant on the performance of their digital assets and the success of their corporate transactions. The biggest risk remains the volatility of Bitcoin and the execution of their merger strategy. What is your take on Strive's Bitcoin holdings and their dividend strategy? Do you think they're making a smart bet or taking on too much risk? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a like and subscribe for more in-depth corporate analysis. And remember to join our Discord community for more discussions. Thanks for watching, and I'll see you in the next one.